The plan for the session, we're going to go through an overview of some of the factors which have affected car benefits in 2017 and 2018. Some elements of it can be quite dry, as you can probably tell by the title of the session. We're going to try and not be too dry about it. I'm going to go about things a bit of a different way. We will be completely honest with you all the way through, and there's absolutely no intention in this for this to be an overlaid sales pitch or anything like that. It is going to be interactive, so as we get about halfway through the session, we're going to go into more of an interactive session with the paddles which you've got on your seats there, and we'll tell you how to do that when we get there. And at the end, we're going to have a Q&A, probably about 10 minutes, but we are around afterwards if you've got any other questions. So I'll hand you over to Chris. He'll give you an overview of SG Fleet.
Thanks, Dave. Thanks, everybody, again. Just to give you a high level, really, before we get into the detail as to who we are and why we're qualified to talk to you about it. So we're an Australian-owned car leasing business that also focuses on employee benefits. We've been in the UK since around 2008. We floated on the Australian Stock Exchange in 2014 with a market cap of around $1 billion. And then what makes up that billion is around 160,000 vehicles worldwide and 15,000 of them operating in the UK. So it's a fairly sizable business, and it's growing at pace. We have within the business in the UK, we have a number of product offerings that we could talk to you about. They range across, certainly in the EB space. We've actually got a unique point where we're the only company in the UK that offers all three different offerings, which I'll talk to you about a little bit later. But there are some key points to that slide, which I'll go into slightly later for you. Give you a bit of scale. I've mentioned before about the size, but to give you some names, as we like to name drop, there's some of our clients. To give you a bit more background to that, there's around 200 of them that take EB products from us currently, with an employee base of around 200,000 people that we deal with every day. So a sizable business, a scalable business. I just wanted to give you that layer of comfort before we start telling you what you should and shouldn't be doing. Okay, so I'm just going to give you the overview of what's happened in the industry for the last 12 months. And then, as Dave says, Dave's certainly the more subject matter expert and is much better at talking about dry subjects than I am. So I'll let Dave go into the detail for you. Okay, so as a really quick sort of high level, some of these things you'll be really familiar with, some of these things you'll be thinking, well, what's that? I've never heard of that, and we'll help join those dots for you today. So operational remuneration arrangements, this came into play last year. I don't know if any of you, looking around the room, if there's any nods. No, it's mainly vacant. Good, okay. We'll do that. We'll cover that for you. There's some lease accounting changes coming in 2019, depending on the accounting standards you work to. So we'll just give you a quick précis on that. There have been some company car tax rate changes as well, which have affected things, and vehicle tax changes. So as Dave said, there's a lot of dry subjects here and a lot of tax and legislation, but we're going to try and whistle through this and give you the high-level facts now and then get into something a bit more interactive. So I'll get Dave to come back up now. Thanks, guys.
Smashing. So OPRA. So OPRA stands for Operational Remuneration Arrangements, and it's the government's intention to reduce the tax and NI benefits of taking non-cash remuneration, where cash was an option instead. So this has affected cars, because cars were specifically brought into scope with it as salary sacrifice schemes have become more and more prevalent. The government wanted to see some more revenue from that, as they felt they were losing income tax revenue by people choosing a car rather than cash. And as such, they imposed some new rules. It's always abbreviated to OPRA whenever you hear anyone speak about it. And ultimately what it really means is that where somebody has an option of cash or a car, the amount that the employee will pay tax on will be the larger of either the cash they could have had or the traditional benefit in kind calculation for the car. So for those who may not know that, that's a function of the CO2 value of the vehicle looked up into a table, depending on whether petrol or diesel, and that's multiplied by the P11D value of the vehicle or the market price of the vehicle. Now, the cash equivalent value is a little bit of a vague point. So the cash that someone could have had for the car. And originally, that was assumed to be the full cost of whatever the car was costing. So that's the car, the maintenance, the insurance, anything else which is built in there. However, there was some other legislation which conflicted with this. And the HMRC has since clarified that this is actually intended to purely be the finance element of the vehicle cost only. So, conscious that's probably quite hard to visualise without looking at it. So this can affect vehicles that are done through salary sacrifice. It can also affect a company car scheme if you've got one of those internally, if the person is also entitled to cash, or if there's a trade up, trade down policy within your company car policy, where the person can either put more to their car or get some back, that can affect it as well. So just to give you a bit of an example up here, and I'm not going to go into this in too much detail. On the left-hand side, just a vehicle is finance rentals, £300. So 12 months of that is 3,600. The benefit in kind calculation is 3,500, and it's as simple as it's the larger of the two. So in that instance, the employee's tax would be taxed on 3,600 rather than 3,500. That's a fairly tight example. Those numbers can get quite wide depending upon the vehicle that's chosen. And on the right-hand side is just an example of the exact same calculation. It's just the car happens to cost £10 a month less. So if that car costs £10 a month less, it actually comes out as less than the benefit in kind calculation, and therefore it's just done on the normal benefit in kind. So that's absolutely fine. Now, originally, so you've probably heard things about salary sacrifice in the market and in the EV publications over the last 12 months to 18 months about how badly affected it's been by operational remuneration arrangements. Can't say that too quickly. And it's because this calculation was the original one, so it was originally assumed to be the full salary sacrifice amount. And if you look at that same car, would have a full salary sacrifice amount of 450, and therefore the employee would be taxed on £5,400 rather than £3,500 in the previous salary sacrifice arrangement. So it would erode completely the benefit of taking that vehicle on a salary sacrifice arrangement under that. And that affected about 60% of vehicles. Some vehicles weren't affected because benefit in kind isn't always cheaper on salary sacrifice vehicles. There's a lot of other things that contribute to that being cheaper than retail, but it did affect it. And if it's possible to have a more dry subject than operational remuneration arrangements, then lease accounting changes are definitely up there. So you may have heard about this, you may not. You'll tend to hear about it generally from an FD who's putting pressure on a change of policy to cash or out of cash, or to change a funding method with a company car policy, for example. So basically, for companies who subscribe to quite specific accounting standards, ultimately it's normally multinational companies or companies who've chosen to adopt these standards. And by that I mean if you're submitting accounts, you basically have to subscribe to a set method of putting your accounts together, and they can vary quite differently in terms of where you account for things on balance sheet, off balance sheet, and all kinds of other financial ways of doing it. What it means is for those companies who do subscribe to, it's called FRS 101, the operating leases will be going on balance sheet as of 2019. Now, I don't think we need to get into that in too much detail, which is lucky, but FDs may be coming to you to say, okay, if you wanted to do a salary sacrifice scheme, for example, we subscribe to that and therefore the lease is going to go on the balance sheet. I don't want things going on my balance sheet, therefore it's off the table. This has started to affect company car schemes and salary sacrifice schemes over the last 12 months. There are various options you can do to change, to alter this, and some companies really want salary cost on balance sheet. For example, companies who are very focused on EBITDA, so private equity owned companies and companies like that. Company car tax. So company car tax is a strange one, and I'll show you an example of it in a moment. But diesel surcharge, everybody was hoping would be abolished. So for those who don't know, for an equivalent CO2 value, there's a 3% uplift of taking a diesel over a petrol to account for the, well, in theory, the dirtier nature of diesel, but it's probably because diesels have naturally lower CO2 values and they would lose tax revenue without doing it. Since then, in the last budget, they upped that to 4% rather than abolishing it. So I'm sure you've seen the war on diesel in the press and various other things about diesel, residual values, things moving up and down. And they're also taking a look at alternatively fueled vehicles and zero emission cars. So if you look at current company car tax rates, it's quite strange in that zero emission cars, the company car tax rates were fixed, so they're still going up to 16% next year. And then as an incentive, in a couple of years' time, they dropped right down to 2%. So you can take a car that costs you normally you take a car and your company car costs you more each year. The way this is going to work is it's going to drop off a cliff if you choose one of those cars and you go a couple of years down the line. In addition to that, road fund licence, so road tax, moved from a sliding scale. So if you had a low emitting vehicle, so something that's 40 grams CO2, 50 grams, it was previously free. Now it's not. If it emits 1 gram CO2, it's £140 a year basically, unless it's alternatively fueled like a hybrid, and then it's 130. If it costs over £40,000, there's another, I think it's £300 or £350 added to that. that can have significant impacts on a company car policy. So I'm going to focus on just company car tax for an example, as it has effects on various car benefits and on company car schemes, obviously. So this is Bob. Bob's decided to go for a Golf because Bob's quite eco-friendly, and really he's got one eye on the tax that he's paid. So I don't want to pay any fuel, and I'm going to choose and it's a relatively efficient, cost-wise electric vehicle. So this year he'll pay 13% tax on it, so £849. Next year he'll pay 16% tax as a benefit in kind rate, which is £1,045, and then the year after it drops to 2% and it's £130. It's quite strange. I can see you've probably got some questions. But yeah. well, if you've got an electric Golf, then that could work. Yeah. So you are Bob. Yeah. So, well, it does make quite a huge difference, as you can see. So, I mean, and I'm in the same spot, so I've just ordered a 5 Series hybrid, and I'm doing this, but mine goes back in 2020, so I'm not going to get the benefit of it. But it is a very strange situation. It's one we've not been in before. So I'm going to hand you back over to Chris, who's going to... Oh, sorry, we can show you these at the end if you want pictures. Hand you back over to Chris. So now my dry bit's done. Chris is going to give you a little bit of the softer side of what's been going on.
And if you want a quote for a Golf, that's no problem. You don't need to see that screen. Okay, as Dave said, just to get back to things that are a little bit more interesting, let's say. What else has happened in the last 12 months that have been sort of speed bumps in the road for the fleet industry and the company car industry? So as Dave's mentioned a couple of times and give you a really good example there is a real focus on ULEVs and alternatively fueled vehicles. So electric isn't the only alternative out there. There's some fabulous work being done by Toyota in the hydrogen space, and there's a ton of other things that are coming out. So I would urge you, if you're looking at alternative fuels, don't just think it's electric, and explore the market and talk to people like ourselves and our competitors, and we can help you with that. There's been lots of conflicting messages in the marketplace. There's a slide that you're going to see in a minute, which is quite interesting, some headlines that have been in the market. And it's fair to say that I'm not going to stand up here and talk about fake news, but there is some messages that have been focusing on certain people's agendas, and actually the truth behind them is quite different. There's been definitely, we've noticed in the last 12 months, people wanting to get away from risk. So certainly in maybe salary sacrifice car schemes or car allowance, where people just want the risk away, they're worried about people leaving, don't want to be left holding the baby. Definitely that's been happening a lot more in the last 12 months. And also the head count restrictions and the focus on head count, and people not wanting to take additional admin on by introducing a benefit that may or not be a benefit. So that's kind of what we've been noticing these last 12 months, and I don't know if that resonates with the people in the audience, but these are the things our customers are telling us, and these are things that we're talking about every day. So more than happy to talk to you about any of this stuff. And then the headline slide, just to show you, these are the kind of things that have been around in our industry. So, salary sacrifice is dead. Not the case. Absolutely not. In fact, the government haven't quite done a U-turn, but they've done very close to a U-turn, as Dave showed you earlier. Administration doubled. Not true. Diesel is evil. It's really interesting, the diesel thing, because the reason so many company car drivers take diesel is because the government incentivized it a few years ago. Now they're saying it's the worst thing ever. So it's very, very interesting with that. But it's actually not true either. So again, explore beyond the headline. And then PCH and ULEVs, we've kind of mentioned that a little bit. So I just want to show you the products that are available to you in the market space in terms of a car employee benefit scheme. So the ones they're typically into 4 brackets really. Your standard salary sacrifice, the personal contract hire affinity schemes, something called novated leasing, which you may or not have come across before, and then standard company car schemes. So to kind of give you the differences, if you like, in a visual way, rather than me just talk to you, what you can see here is we've separated it. So who's the contract with, what's the administration like, what's the ET risk, and whether it's regulated. So to go from left to right. So on the left is personal contract hire. So this is pure affinity. This is where you as an employer have nothing really to do with the agreement apart from setting it up for your employees. It's in the name of the employee. There is no admin. There is no risk. And there shouldn't be any benefit in kind. I say shouldn't. There's some question marks that we're working with some legal people and the revenue on at the moment about potentially there could be if you introduce certain things, but at the moment we believe there's not. And it's fully regulated, so you get all the FCA benefits, cooling off periods, treating customers fairly, all that kind of good stuff. You then have the other end of the spectrum, which is salary sacrifice, which is in the name of the employer. administration will typically be borne by somebody in your organisation dealing with fines, payroll administration, end of contract costs. There is always an ET risk. Yes, it can be managed, it can be mitigated, but there is an ET risk because ultimately the contract is with you. There is benefit in kind because that works as part of the calculation, and it isn't regulated. So they're kind of the two ends of the spectrum. And then we do something called novated leasing, which is kind of in the middle. So what you get there is it's fundamentally a personal contract hire. So it's in the name of the employee. But if it works in terms of Bob and Bob's VW Golf, that would really work well on a salary sacrifice scheme. So we give you the option to do that. But if they leave, it's fundamentally a personal lease. So you kind of get the best of both worlds, and you're somewhere in the middle. Okay. What we're going to do now, because we've done lots of talking and you've probably seen the paddles that are sprinkling around and thinking, are we playing ping pong? Are we spanking each other? What's happening here? So I'm just going to tell you what we're going to do with these. They have two sides. One says yes, one says no. Dave's going to come up in a minute and take the session. All we'd really like you to do is just give us your thoughts. Yes, no. If you don't have an opinion, don't feel obligated to get involved, but we'd kind of like the end of this presentation to be about what you want rather than what we're trying to push. So I'll get Dave to come up and just go through the session.
Smashing. So as Chris says, we're going to use this to drive the content for the rest of the session, as we could be up here for hours boring you with all different kinds of dry subjects. But we'll try and take it in a route in which the people in the room have got the most interest in, and we'll cover as much of it as we can. So first of all, can we just ask how many people here have responsibility for a company car scheme or a cash allowance policy?
Yes,
okay.
No, yes, no.
Yeah, you're sort of
yes, no, yes, no.
within there. So I think the majority of the rooms are on no. So we're probably going to so we'll skip past that because there's very little point going through it. If anyone does want more information on it, the yes, no, unsure, not quite worked it out yet, then we can probably help you later on. Yeah. So. By that, we probably assume that people are here to think more about optional company car schemes and car schemes as a benefit. So all of these questions are related to that. So I think if we go through these one by one, and for now, just vote on with a yes on if this is a reason which you either wouldn't do a company car, a car benefit scheme, or if you've got one, it's a big problem for you whilst doing it. And what we'll do then, we'll rank them by the importance to you, we'll go through them one by one, and if any that people feel really strongly knows, we'll do those as well. So the first of all is risk. Who feels that risk is either causing them a problem within a car scheme or would stop them from doing one? Okay, so that's pretty much everyone. Yeah, so almost everybody. So, okay. So I think risk is potentially, from, as Chris showed you before, most applicable to salary sacrifice schemes when it comes to the car benefit. So there's alternatives out there, such as PCH and novated leasing, that remove risk completely. But salary sacrifice is probably the most popular still benefit that's out there. It's one of the most established, but it is one of the ones in which the risk is potentially carried more by the employer. This typically falls into a few key areas, which I'd imagine from the amount of fairly decisive yeses this time you're aware of. So early termination, people going on maternity and paternity and long-term sickness. One that's not mentioned here is changes in the minimum wage. So if the minimum or living wage changes, then you have to have accounted for that. Otherwise, typically the employer bears the costs. And one which people usually forget, but sometimes aware of, is if you're bringing people into what is essentially a company car they're in, and they're going to have accidents, is it going to affect other things within your business? Have you got a reputational risk within there as well, if that was to happen, someone in a company-provided vehicle, and how you could mitigate that? So we're going to talk mostly about the first couple of risks there, so the typical, your early termination and the maternity and paternity pay kind of risks. The other risk is part of an overall risk strategy, which we can also have a talk about, but that would be another hour just on its own, because that's quite a wide-ranging subject with hundreds of factors. So the usual ways of mitigating risk on a SALSAC scheme are to outsource the risk as fast as possible to your supplier. So most established salary sacrifice providers now will give you a reduced risk option where that risk is outsourced and they spread it over their entire salary sacrifice fleet. Those generally cap risk rather than remove it completely, so you're looking at somewhere between £500 and £3,000 worth of total liability depending upon your supplier that you choose. The other option is to just remove the employee from the equation completely and just go contractor direct with the employee, which is something like a personal contract hire, where the employer doesn't have any financial liability for it whatsoever. Affinity schemes very much similar to personal contract hire, just involve potentially different funding methods, and novated leasing, which actually still remains a personal lease and there's no liability to the employer at all. And that novated leasing is essentially a salary sacrifice scheme with a credit check at the beginning, where it sits as a personal contract hire vehicle and is temporarily brought over to the company to put through payroll. But in the instance of any inability to pay, so in any of the instances, maternity, paternity, and the others, the novation cessates, it's called, and it just drops straight back into being a personal lease, comes back out of their bank account. If that doesn't happen for any reason, that's on the supplier to interact with the employee, and the employer isn't involved at all. Oops. So, managed to skip past one there. Okay. So, administration, which I did see a few nods, I think, before in terms of these kind of schemes. Who is that an issue for in terms of either a scheme you've already got or one which would stop you from doing it? Yeses again. Okay, so we're pretty almost unanimous again. So, the short answer, and probably one you're not expecting me to say, is that you could definitely be right, and it certainly can be more hassle than it's worth to introduce a scheme. There's a few reasons for that, and the one is it's generally not far off the same amount of administration for a scheme for 1,000 employees as it is for 10. There's not a massive amount differently involved in administering it. So what might take an hour or 2 hours for 1,000 employees worth of take-up is probably worth it. If that's going to be that for one employee take-up because you've only got 10 or 20 employees or 30 or 40 or 50, it's probably not. So it is a balancing act. And for that reason, anything which involves employer administration generally only becomes worth it for both the employer and the supplier because of the admin involved for anyone with over about 1,000 eligible employees. And an eligible employee is somebody who has the salary and the contracts to be full-time employed with enough salary to be able to sacrifice enough not to go over the living wage or minimum wage over the course of the contract, not just on day one. So if you've got a scheme and you're just checking against living wage right now, that's not going to be the case in 3 years, and generally they'll have a car for 2 to 3 years. You don't want to open yourself up to that. A lot of administration can be taken off you by the supplier, especially when we spoke about Opera earlier and the calculation. That looks like it's a lot more work. It shouldn't be. The supplier should be doing all of that work for you and providing you with reporting so that it's the exact same process you had before. There is more administration from a supplier side, but that's on us. That's just part of the industry. Like I said before, there are zero administration products out there where basically you just have to set it up and then you never really have to do anything else. And you've got varying degrees of administration, which we'll go through now. So there is increased Opera reporting, as I said, but it's mostly on ourselves. We would provide you, or a supplier will provide you with a report. There's a couple of extra columns in there, so it may mean that on your P11D reporting or on your benefit in kind reporting, however you do that and what systems you use, there's a bit of admin to make sure they've got the fields for us to be able to give you the files to input into it. There is in-life administration for salary sacrifice schemes and not for novated or PCH, where there's payroll changes, payroll charges, additions, removals. So there's an element of that. It's typically not large, but it is there. Reporting, so if you want to be reporting the benefit of this to your business, and we're going to come on to the benefits a little bit later, there's a little bit of work involved in that, but again, your supplier should be making you well aware of how beneficial the scheme is, otherwise they're not doing a very good job with you. And marketing. Any car benefit scheme is 100% dependent upon the level of marketing you're willing to do to your employees. It doesn't work on a window-based marketing schedule like a lot of the benefits, because people's cars will expire throughout a year, throughout a 2 year, throughout a 3 year period. So you have to agree up front, and you can save yourself a lot of hassle by doing an upfront marketing plan with your supplier. Have that agreed for the next 2 or 3 years in line with all of your marketing constraints or anything which corporate may be handing down in terms of what you are and aren't allowed to do, and branding and things like that, so that you're not having to do it and keep revisiting it throughout the life of the relationship. So just run very quickly, and I'm not going to run through each step of these, but this is going to show the steps which employees and employers go through to put a vehicle on each one of these car benefit schemes. So within the first one, this is salary sacrifice. Everything underneath the dotted line towards the bottom of the screen is supplier administration. Everything above is either set up, so the employer contracting with the supplier is with the employer, but it's done right at the beginning. Everything else is just process. So on a salary sacrifice scheme, you'd be authorising the order, and doing a minimum wage check. You would be approving marketing material and an approach, usually on a 12-month to 24-month basis. There will be a payroll administration once the vehicle goes live. You would have to report the P11D info along with everything else that you do, so there's some administration there. And then under step 5 is just a bit of in life. So if anyone gets any fines, for example, that the supplier, technically the supplier has a contract with the employer, not the employee, so it's recharged to the employer who recharges to the employee through payroll. There's some in life administration there as well. PCH, I'm going to really skip past this because there isn't any. The employer's not involved, there's no payroll, there's no in life, it's purely an introduction from the employee to the supplier, and then that's your involvement ended and you don't have to worry about it. Novated leasing, again, is somewhere in the middle. There's a few more steps on this, as there's a personal process done up front and then a smaller process for the employer just to flip it into a novated agreement with them. However, at the beginning you would be approving any marketing material, again, which is the same as salary sacrifice. There would be a payroll edition of the sacrifice if that's approved. There's less checking involved, because if it ever happens where living wage or minimum wage means that the sacrifice can't be taken, again, it ceases as a sacrifice and it just drops into being a personal lease again. The P11D information reporting is exactly the same, but there's no in-life admin because the contract is direct between the employee and the supplier. So if there's any fines, if there's any problems with the vehicle, anything like that, if they're not getting it serviced, there's no contact with the employer. They have the ability to speak directly to the employee and to hold them accountable for it. Okay, so the next one we've kind of touched on a little bit earlier. We do have some extra information on here. So who would consider that either on the scheme that you have or what would stop you from implementing a scheme, that there will be a lack of benefit for the employee? So what's the point? Okay, a little bit more of a mixed bag, but predominantly it's a yes. So completely understand that, and that's largely been a key industry message over the last sort of 12 to 18 months, where you've usually got suppliers saying, no, it's absolutely fine, don't worry about it, but generally the articles and the things about salary sacrifice which are out there, and just generally the message from the government of going, we're going to try and tax this more now, can say there's just not as much benefit. And I'll walk you through this in a moment. So that is very popular, it's quite widely held, we're hearing it a lot. When it's broken down into the facts and figures behind it, it does tend to dissipate. So there is a benefit for the employee, otherwise we would be closing our schemes and not doing it because employees simply wouldn't take the schemes up. And under the original Opera interpretation, actually that perception had a point. So about 40% of vehicles were affected, as I said before, by Opera. So about 40% of vehicles you were losing any sort of tax and NI benefit of bringing that in. Now that doesn't mean that the vehicle still wouldn't be beneficial in the scheme, but it did erode that benefit significantly for those. But under the clarified Opera, where it's purely the finance element, because that number's always much less, it rarely exceeds the benefit in kind of the vehicle. So about 90% of vehicles which we see quoted on our portal are completely unaffected by this new legislation. So the government's Opera legislation, when they put it in, actually didn't do what they were hoping in terms of salary sacrifice schemes and generate that extra revenue, so far as we can see. Rising company car tax does start to affect the benefit of salary sacrifice, as I showed you before, even on that goal for the next 2 years, which is a fairly common salary sacrifice type duration. It really does affect it in terms of it rises a little bit. However, I'll show you in a moment with Indecisive Bob, who's changed his mind because he was on a Volkswagen Golf and now he's gone for a 1 Series. This is one of the most popular cars on salary sacrifice schemes. You see a lot of BMW 1 Series and Audi A3s, especially the 1.6s with quite low CO2 values. So this is a typical car. And Bob's taken a look at it and he's had a look, and Bob or me the other day went out to BMW and got a quote for this car. Exactly the same mileage, exactly the same thing. This is 3 years, 12,000 miles a year, no deposit. So if you look at the overall net cost, so all of these figures are in there, and this is a public sector example, so there's a pension contribution saving in there as well. Out of Bob's net pay, he'd be taking £373.64 this year home if he took that car. So they'd be taking £373.64 out of his net pay essentially for that car. To get a quote for that from BMW, it was £436 just for the car. We made some assumptions on maintenance that it'd be £35 a month, which is largely in line with what we would pay for it. Insurance, a quote on Bob, who was, I think Bob was 35, lived in Manchester, middle of the road insurance group. It came out as about I think it was about £360, something like that a year, so about £30 a month for insurance. Gap insurance, so typically on a leased vehicle, the insurance wouldn't cover the settlement of the lease, it would cover the fair market value. So Bob might want to cover himself, and to get the equivalent of salary sacrifice, which doesn't require gap insurance because it's a specialist insurance policy, it's about £15 a month. It's quite a short lease. So overall, that car for Bob to go and get privately would be £516 a month. And he wouldn't own it at the end. That's handing it back exactly the same, and that's getting it direct from BMW on BMW's special offer price as of last week. So overall, Bob's saving about 27.6% by putting that through salary sacrifice rather than going and getting it himself. So that's a fairly hefty saving. But the key thing to look at really is what we've been talking about, and the general perception that salary sacrifice is now not economical is because the tax and NI benefits may be eroded. But even if that's the case, only 5% of the saving on that vehicle is due to any tax and NI benefit at all. All the rest of it is due to just the sheer scale of somebody providing something to all of your employees and the purchasing power that that gives, and that it's provided as a company car, potentially, depending on if your company wants to reclaim the VAT on it, all those other different elements. So, I mean, even when you look at the next year, so dropping this into the year afterwards, when tax is going up, still saving 25%, and 3% of it is due to tax, so you can see that dropping slightly. And the year after, there isn't the drop to 2% of this vehicle because it isn't an EV, so it continues to rise, and it's still saving 23% in that year, and about 1% on tax. So it isn't the tax benefit which is really driving most of the saving and most of the efficiency for your employees on a car benefit scheme. So regardless of what happens in the background with that, these are still very efficient schemes for an employee, and the benefit is unquestionably still there. So the last point here, so, and this is usually quite key to implementing a new scheme or closing an existing one if this perception is not there. So who believes that there's a lack of benefit for the employer within salary sacrifice schemes? Okay, again, fairly unanimous. So, the NI benefits, which are typically the thing which car salary sacrifice schemes have been sold on for quite a few years, been publicised on, the corporate NI benefits are largely inconsequential. They're not huge, and if you were putting a scheme in there purely for an NI benefit, the ones of you who said yes, that there is a lack of benefit would be correct. You can put scheme savings in there. As you saw before, there's a 25% saving, 27% saving for employees. Generally looking at between 25 and 30% as a rough guide against retail. You could put an administration fee in there, you can create scheme savings, but to talk about NI savings is inaccurate. You will have seen things out there that say, they're all still there and they're all still fine, and I'll show you in a moment why that's a little bit disingenuous. However, by putting a car scheme in where it's zero or very low risk to the employer, you can have significant benefits on employee retention. And I'll show you the potential. There's a bit of faith required in it in terms of it's very hard to say someone definitely stayed purely for a car scheme or a benefits package. But that's kind of what benefits packages are about, is to make you the employer of choice within your sector with a view to if you can increase retention by 0.5%, 1%, 2%. And as this is probably the second biggest purchase anyone will make, it has to have a contributing effect to that. So when we look at Bob, who's back again, and he's in his one series. Now, if you look at Bob within there, he's making 20 quid a month in NI and tax savings within that. Actually, within that vehicle that I've chosen, the employer's in a negative position when it comes to NI, so it will be costing the employer £16 a month in extra NI because the benefit in kind is more than the sacrifice amount. Now, I'll come on to another slide where I'll explain that in a little bit more, because I understand why that might be hard to fathom without seeing the figures, but ultimately the employee saves NI and tax on his salary, but he only pays tax on the benefit in kind. There's no NI for the employer on the benefit in kind, but for the employer it's purely NI on one and an NI on the other. So in this instance, the employee is saving 32% and paying 20%, and the employer's saving 13.8% and paying 13.8%. Now, within these examples, that £16.18 is wrapped into that £429.67 cost, so actually it's neutral because we've wrapped it back in. But if you didn't, and you were to say that the employer was to take the risk and reward on NI, the employer in this case would be £16 a month worse off for an employee getting a 25% a month benefit for him or her taking a vehicle. So you will have heard NI savings are all still there, it's completely unaffected, and I'll show you where that comes from. So if you look at the total salary sacrifice amount per year for that, it's £5,156 a year. The benefit in kind calculation, even in year one, is 6,563. So naturally, if you're paying 13.8% of one and 13.8% of the other, it's more. So the employer would pay £711.54 on the actual salary, or £905.75 on the car. Now, when you hear people talk about NI savings are still there, under a typical salary sacrifice calculation, all of the Class 1A NI costs within the calculation in the portal is automatically passed back onto the employee within the cost that they see for the total salary sacrifice amount. It includes that. And you'll generally have a discussion with the supplier on the percentage of NI saving to retain. There's a perception that it's the difference between the two amounts, that you would imagine they take a car, it's lower on benefit in kind than it is salary sacrifice, therefore there's a saving, and then you keep a percentage of it and you give a percentage back to the employee. But actually, it isn't the case. You charge the employee the whole amount on the benefit in kind, and then you retain a percentage of the saving on the full salary sacrifice amount. So the typical amount quoted is about £300 a year saving per vehicle on salary sacrifice that you can make, but that's £300, but the employee is still paying all of the benefit in kind on all of the NIC on the benefit in kind value rather than the salary. So it's a bit disingenuous to say that the companies, we're reducing the company NI bill by putting this on. It's not. Under this vehicle, the NI would be increase. So the company's NI bill would increase. But if you were saying, well, we're taking all of the NI saving, but all you're doing is charging that £711 a year to the employee. So the employee is just picking up a larger chunk, is effectively paying a portion of the company's NI saving. Now, if employees knew about that, it would be quite difficult and could do the exact opposite of what you're intending to do by putting in a large benefit such as this in, which is why it's important to be quite open and honest with it. And the simplest way of doing it is to completely stop talking about NI savings when it comes to company car schemes. You pass on the total amount of the cost on the benefit in kind, and you pass on the total amount of the saving on the salary. Now that means that the company's never in a disingenuous position. It means that the company is always cost neutral and that the employee's getting any benefit of any NI reduction or is paying the extra towards it. Now £16 for the employee to pay, seeing as they were saving £127 a month, isn't a lot. They'd probably still take that. It doesn't matter. But it leaves the employer in a neutral position from an NI perspective. And NI savings are fairly small when you look at the overall benefit. So when you look at retention benefits, you've got employee replacement costs to take into account. And when we looked into this over the last few years, there's wildly varying different amounts for how much it costs to replace an employee. Oxford Economics say it was £30,000, which on average, which sounded quite high. 5,433 in recruitment costs and in an employee time to go and recruit, and £25,000 you pay someone in salary on average until they're performing at the full 100% value of the role from the person that they've replaced. CIPD came in a slightly more realistic, probably £6,125. I think that was quite a long time ago. They're still quoting the same figure they quoted in 2007. So potentially there's either inflation on that, either they've assumed that other efficiencies have kept that down. If you look at car schemes, you've got about 5% take-up rates realistic on a good salary sacrifice or car scheme, PCH scheme, no release scheme. So if you were to take the assumption that if we put this in, we might increase our retention by 1%. Now that's a fairly high figure, but on 1,000 employees, that's 10 extra employees stay a year. So that's not every employee you get taken on it, which would be 50, but say 1 in 5 of the people who take a vehicle on the scheme probably going to stick around because they're not going to get that benefit if they leave. They're going to lose that £100 a month, so they have to get extra salary to cover that before they even start to look at an increase. So that would give you about £54,000 a year in retention benefit. But if you look at the quoted typical NI saving of about £300 per vehicle per year, that would be £15,000 in total. So it dwarfs it. And it doesn't have to be close. It doesn't have to be a very close decision. Ultimately, as long as you assume that the car benefit will increase in some increased retention, it will nearly always outweigh any NI saving. The only thing with that is it's convincing an FD who wants hard and fast figures, because the NI or a charge that you were to put in there to the employee is actual money, whereas the retention is almost theoretical money of what it would have cost if we didn't do it. So there is a challenge there, but there's absolutely no reason why we can't help you overcome that, or a supplier can't help you overcome that with a detailed study of what your employees want, for example.